In today's video, I am going to be talking to you about why RRSPs can suck and be terrible for your investments. Let's get down and let's check out the reasons why I say this. Okay, so obviously the advantage with an RRSP is if you make $1,000 and you put that $1,000 into an RRSP, you are no longer taxed on that $1,000. So you actually save and technically make, let's say, if you're getting taxed at 20%, you're saving around $200. So that's absolutely fantastic. However, there is an issue what comes with this, and that is if you, let's say, make money in an RRSP and you take that money out, let's say 40 years down the road, if in 40 years you're getting taxed at higher than 20%, then it is a negative for you. That's why you should always wait to invest into an RRSP until you are making, or at least at the highest tax bracket that you'll probably reach. That way, when you get into retirement and you actually pull from an RRSP, you're actually making money, because if you're putting in at 20% and you're saving only 20%, and then down the road you're getting taxed at, let's say, 35%, you're actually automatically losing 15%. So that right there, you could be negative. Let's say you're taxed at 35%, you're actually negative $350 down the road on that same $1,000. However, meanwhile, you're going to be hopefully making money on that $1,000 that will supersede anyways that $350 negative for taxes, which is a negative of technically $150. So hopefully you're making more than that in the RRSP with your investments over that 30, 40, whatever year period. However, that $1,000 that you are putting into your RRSP, you need to be safe with it. You cannot be risky. Risky with that $1,000 could cost you an arm and a leg. Let me explain. If you were to invest that $1,000 and you lost 50% of your investment because you went risky and you lost 50%, you are automatically down $500. Then when you withdraw that $500, let's just make math really easy and say you're still getting taxed at that 20%. You're actually now only at $400. Out of that $1,000 after taxes, if you went with risky investments, that lost 50% of your value. And when that comes down to the fact, that's a massive loss. Because when we really think about it, we just essentially turned after tax $800, because this would have been taxed at $200, which would have made it about $800. You just lost $400, 50% of what you would have had anyways if you just kept it as cash. Technically speaking, there would have been inflation, but let's say you were invested in something that stuck with inflation, and then at that point you technically lost $400. Now, this is another downfall of the RRSP. That $800 to $400 split is negative $400. That's huge. And you can't claim a tax loss on that. Because if you held that investment and let's say you lost that 50% and you had it in, let's say, a cash or a margin account where you can actually claim tax losses, which is when you lose money on an investment that can actually go against your earnings that year. That means that $400 is gone completely. Meanwhile, if you actually just didn't invest in that RRSP, didn't put money into the RRSP to invest in stocks, and you went risky in a margin account and you lost that $400, well, guess what? If you made, let's say, $30,000, which is an okay income for somebody who is just starting off, let's say, then at $30,000, that $400 loss that you would have had would actually only make your taxable earnings $29,600. Which means at least you can make back about $160 of that $400 loss because of tax losses. And that is a fantastic way to be able to offset your earnings 1 year. If you have investments that you've held for 5 years, let's say, and they just haven't gone anywhere, they're losing you money, and you had one fantastic year of making money, you can just sell those stocks, get a little bit of money back from the taxes from those losses, and those losses don't hurt as bad. But you cannot do that in an RRSP because it's a tax-sheltered account. Same idea as a TFSA. Any losses that occur in those accounts don't exist when it comes to taxes. They actually hurt you more because then you are essentially looking at basically having an account that you can't put as much money in. If you had maxed out your TFSA and you put $76,000 in there and you went 50% down and you sold, guess what? You now can't just top up that TFSA. That's gone. That contribution room is gone. You now need to make that whatever $38,000 that you have left. You still need to make that back. And of course, now instead of it being just a 50% jump, you now need to have a doubling, 100%, which can take years. So make sure if you're investing into an RRSP, you're doing it when you are at a high tax bracket, not when you're 20 years old and just starting off, because you're probably only paying 15 or 20% taxes. While maybe 10 or 15 years down the road, you can then be at that 30 or 35 or 40% tax bracket. And at that point, you can then be saying, okay, well, now it's a good time to invest. However, I'm not saying don't invest. What I'm saying is invest in a TFSA. It's the same thing. And guess what? Any money you make in it is not taxed. Also, invest in margin and cash accounts because then you can actually have more riskier investments in those. And if you lost money in an investment, then at least you can claim taxes and it doesn't hurt as badly. Anyways, that's my tips for today. I hope that you've enjoyed. If you have, hit that like button, subscribe. I'll see you guys again next time.